our subject for today is the commercial insurance marketplace. Not all companies need all kinds, but most companies need more than one kind of insurance, and hearing about all of them today. Insurance, it's a very interesting collection of submarkets because they don't all move together. They don't all move in the same way. When things affect them, they're affected by different things. Some of the stuff that affects the profitability of insurance companies could be anything varying from something like a pandemic to something like a hurricane or a blizzard to something like dysfunction in the financial markets. Because remember, one of the sources of income of insurance companies is not just premiums, but investment of the huge amounts of cash that they are sitting on. It's a key part of their profitability. So changes in any parts of those markets can have a big impact on pricing in the near term and pricing in the near future in insurance. So there's always some interesting stuff going on. One of the things I wanted to mention, and I put it in the announcement that went out, is that Marsh McLennan has their own index of the insurance market that they created about 10 years ago. And it's rather noteworthy that for the past 14 quarters in a row, the index of pricing has risen. Doesn't mean every kind of insurance has risen, but the overall index has risen. And we'll hear a little bit more about that when Trindle gets into that to present some of this stuff. So let me just tell a little bit about our speaker, Trindle Reeves. She's been in the insurance industry for over 30 years, knows it really well. Back in 2006, and she's been with the firm for a long time. Before it was Marsh & McLennan, it was known here locally as Barney & Barney. And Trindle, back in, I believe it was 2006, became a principal in Barney & Barney. She is today the chief sales officer for the company, overseeing all sales countrywide. Is also active on the management committee of the firm, and is also, beyond just what she does professionally and with her career, also is very community oriented in terms of having helped initiated and set up what was called the Grow Women's Network within Barney & Barney, basically to help women in the firm advance their own careers, their own professional lives. And she serves on a number of boards in the San Diego area. And let me just see if there was anything else critical I didn't want to leave out. Trindle, if I leave out anything critical, please fill it in. But I just wanted to mention she has her undergraduate degree in psychology from University of California, Irvine, and has a couple of critical certifications for insurance folks, a certified insurance counselor, CIC, and the, where are we here? Oh, accredited advisor in insurance, AIA. So on that note, let me turn it over to you, Trindle. Take it away.
Thank you, Dan. So great to be with you all. I work and live here in San Diego, and really happy to share with you what we're seeing in the marketplace. As Dan said, I've been doing this for a really long time, and we are now coming out of an unprecedented time in our business. I'll tell you, from year to year, there's always one line of insurance that's kind of distressed, having problems. Through the pandemic, it was such an exceptional time in that just about every line of insurance was distressed, meaning rates were going up, coverage terms were being restricted, deductibles going through the roof. So to manage that across a portfolio of insurance products is really, really unusual. The good news is we're starting to see some improvement. So I'm going to walk you through what we look like through 2022 Q1 And then I'm going to also just give you anecdotally what I think is going to happen in the coming months through the rest of the year with that area. And then if you have any questions, certainly stop me along the way, or I've got my chat open as well. If you want to put it in the chat, if that's more comfortable, that's fine too. Okay. So with that, we'll go ahead and get started. You know, as Dan mentioned, just on the tee up here, we have had, you can see here, literally right as we entered the pandemic, you can see just what happened with the rates. And, you know, the line here is the US and the bars are global. So from a US standpoint, right now we're looking at an overall, with all lines of insurance, a 12% increase, which compared to where we've been is much better. But if you think about this, if you look, you know, everybody renews their insurance once a year. So when you start here and you've got a 6% here, and then you get a 19% here, and then you get, you know, a 15% there, you add all those up over the last 3 years, and you're talking about substantial rate increase on clients' programs. The good news is we're starting to see some moderation, and I'm going to talk you through the areas that we're seeing some improvement. And then there's a couple areas that are still really challenging that I want you to be aware of. All right, I'm going to start with property. And I got to tell you, you know, this area is highly driven by, you know, natural disasters, catastrophic issues. Certainly in the West Coast, wildfire risk is becoming huge. But we're seeing overall, you can see big improvement here at 7% rate increases in Q1. I will say companies that have good property, meaning highly protected, good sprinkler systems, good construction, recent construction, those accounts might be getting that or better. But it's the older buildings, non-sprinklered, in a really isolated brush area that are seeing really large increases, and it can be, you know, significant double digits. So let me just talk through, and there's a lot of text on some of these pages, but I want to walk you through some of, you know, the big items. The good risks are being delineated from the bad risks, right? So it's very important that when you're going into your renewal, that you're explaining that to the insurance companies as to what you're doing to improve a property. We had a client that had a bird's nest in a sprinklered wood frame building, and you know, the underwriters went out there and said, until that thing's gone, we're not going to write the risk. And it was significant because it was a fire risk for the roof, and this is a manufacturing plant. So they had to, you know, clean up all that before they could actually have the underwriters quote it. There is a big thing going on right now in property, and we're actually sending a notice to all of our clients this week. And it has to do with valuation. So when you build a property program, you take your fixed assets and you put them on what we call a statement of values. It's a spreadsheet that itemizes all of your values. And those are typically for insurance purposes valued at replacement costs, where you might hold them as depreciated assets. For insurance, we're underwriting them as replacement cost. Replacement cost today is very different than what it was 2 years ago because of just the cost of goods, right? So underwriters are scrutinizing the values on the statement of values that clients are submitting, and they're challenging the client about how much inventory it is they're holding, how much it would cost to rebuild the building or replace a piece of machinery. Further, they're challenging on business interruption, which is the coverage that actually pays lost profits and extra expenses during a downtime. They're challenging the client. If they're saying it would take 2 months to rebuild, 4 months to rebuild, they're saying, no, not with the supply chain issues. It's going to take you a year or longer to get that material or to get that product that you need to really be back up and running. So they're challenging the rebuild time. We've had several clients have losses, have claims where they're exceeding the limit of insurance, both on the physical asset, the property side, as well as the lost profits and income side of the house. So we are really working with our clients to check the boxes and make sure that the valuations are correct, rebuild times correct for business interruption, And you've just got to really look at that. And if you're not looking at it, the underwriters are going to, they're going to ding you and either potentially not even insure you because you've not updated your values. So that is a hot topic right now, and I don't see that changing anytime soon. And I think you'll hear more about it in the coming months. So cargo and inland marine, this is considered a property coverage, and I'll explain why. Many clients that have high inventory values, there's a way to insure your inventory. Instead of insuring it as property, you would insure it as cargo because it's moving all the time, right? So if you have a subcontractor in China that makes your product and it's in their supply chain, you can actually insure that all over the world, anywhere in the world, rather than insuring it on property. You can insure it as cargo because it's moving. And when you insure it as cargo, you get more coverages, you get earthquake, and you get, a lot of times you get flood, and you also get about a 30% rate reduction when you carve out the inventory from the property program and insure it on a cargo program. And that's called a stock throughput in our world. So cargo is really important when you're thinking about property, because you can drive lower rates by carving out that inventory and insuring it as cargo. So we're seeing a little bit more favorable cargo rates, so plus 5%. I will say that there's new entrants in the markets. London is a very popular market for cargo programs. There's a whole bunch of new carriers coming in, so there's competition, and this pricing on this line of coverage is going down, and we're expecting to see more favorable results. So that's even another reason why a client would want to insure the inventory through the cargo program on a stock throughput. All right, any questions on property before I move on? I'm going to talk about casualty.
Hey, Trendle, could you give an example of a significant piece of equipment to which that would apply?
Are you talking about the cargo piece or?
Yeah, treating it as cargo instead of fixed.
Yeah. So let's say I make a golf club. Okay. And I've got the club heads are made somewhere, the shaft is made another place, and it shows up to my warehouse, and we package it and we send it directly to clients. So that raw materials and work in progress, that inventory that's in the supply chain, you can insure that as cargo. Even when it's in your warehouse, it can be insured as cargo because it is moving all the time. So rather than what we do as a broker is many times we will remove that property, that asset from the property program and insure it as cargo because you drive a better rate and you get more coverages overseas.
Well,
yeah. And there's a technical expertise required to structure those programs. It's if you don't know how to structure it, you could do it wrong. And then that could be bad because you want selling price valuation on the finished goods and then replacement cost on the work in progress and the raw materials, right? So that all has to be figured out up front.
Very interesting.
Yeah. Yeah. Okay. Casualty. And when I think about casualty, it's also liability. All right. Liability coverages for lawsuits, and it can range in scope of all different types of lawsuits. So I'm going to talk to you kind of generally about casualty coverages here. And overall, the market, I've been doing this a long time, and we were flat on rates. I mean, you can see here for years and years and years, there was nothing going on in general liability. I mean, this is slip and falls on the premises. This is products liability for you in the construction area. It could be completed operations, construction defect, that kind of thing. You saw some significant increases in the casualty area. This is on the primary. So this is just on the base, the first layer of insurance. So I'll talk more about that in a minute. So we're at a 4% increase, which is moderate. That's really good that has come down. And we're expecting it to further come down, getting back to flat. The issue with this area of coverage are a couple things. Number one, we have what's called nuclear verdicts going on. So a lawsuit against a company for a product liability case 5 years ago might settle for $750,000. Okay. Today, that same lawsuit will settle for 10 million. And it's because of the sentiments of the juries. The juries want to punish corporate America. And they are weighing in hard against a company. And so these settlements across the whole industry have increased dramatically. And that's what's driving up the cost. Okay. When you add auto fleets to that, it gets even more, because auto is a type of casualty coverage. And I'll talk about that in more in a minute. The one area of coverage inside general liability that we're seeing real difficulty with is sexual abuse and molestation coverage. We call it SAM. So those of you involved in nonprofits or anything having to do with elderly or children, this area of coverage is the worst probably in the entire market. Very, very difficult. There's only a few carriers that are willing to write it. Really punitive terms as far as the cost and the deductibles are significant. So we're working on some really tough renewals for July 1st, and this market is really distressed. So when you build a casualty program, you have your underlying insurance, and then you buy an umbrella, okay? And an umbrella is really today called excess. There is no umbrella feature. These policies are now so broad that they actually don't drop down and fill in the gaps of the lower, because the program is so broad, it is truly just an excess. It's how you buy more limits. Because of the nuclear verdict situation that I talked about, we're seeing big increases in umbrella pricing because these claims are impacting the umbrella where that they didn't used to. So it used to be that you could get $1,000 a million for in each additional $1 million. It's not that anymore. Really, they underwrite it aggressively. They look at what your claims look like, what industry you're in, what the legal trends are. But we're seeing, we have seen up to 30% increases on the umbrella. And that is now starting to moderate at about 6 to 10%, which is great. It really also depends on the industry that you're in. You can see here, construction, habitational, hospitality, transportation, those are seeing more difficult renewals. There is also this thing we're calling kind of the gap, where you can get, let's say, your first 5 million, your primary layer, and then let's say the client needs $50 million. The attachment point many of these umbrella excess carriers want to start at is 10 million. So there's this $5 million gap at the early layer. That segment of the market is very tight right now. There's very few people doing what we call lead umbrellas right after the primary layer of insurance. So that's a challenge, and we're hoping more players start coming into that market, and we can drive that cost down a little bit more on the umbrella. Workers' comp, this is like the bright spot, which it used to be that workers' comp was always the problem child, and it's actually the bright spot right now. And I think part of this, the reason we're seeing a negative rate environment is because people haven't been working at their offices. So there's just less exposure, so to speak, right? As people come back to work, we are seeing claims increase. I expect that this area of insurance over the next couple of years will start to turn more in the positive category. But right now, from what we can see, globally, nationally, we're seeing, rate reductions generally in workers' comp, which is really, really great news. There are some regional competitors, names that you probably don't even know, like you wouldn't necessarily, there's like the Chubbs and the Travelers and the Hartfords that everybody knows, right? But there's some regional competitors like CopperPoint, AmeriSure, Century. These regional players are strongly rated and provide really great value and great competition against the big guys. And they're really doing a great job offering competitive terms. Not every insurance broker is able to work with all of these regional competitors. You have to have an appointment as a broker with the regional competitor, and you have to commit to a certain volume of business. So not every broker can get to every market, so to speak. So that's something that's important from a broker selection standpoint. All right, any questions on what I've covered so far? We good?
Trindle, I have a question on the workers' comp coverage. How have carriers handled claims for people who have been injured at home? Are they covering those, or are those being denied?
Good question.
Oh, yeah, no, there's a presumption in California, and I think there's several states, but generally there is a presumption that it is a workers' comp claim. It is presumed. If you have COVID, it is presumed to be workers' comp. Yeah.
Is that what you meant by your question, having to do specifically with COVID?
No, I more meant that they tripped over their desk and hurt
Oh,
themselves at
Yeah,
home.
that's right.
Yes.
Yeah.
Oh, yeah, like the work from home. So yeah,
Yeah.
they're carpal tunnel. Like I had horrible back issues from sitting in a bad chair. Yeah, those kind of things are definitely workers' comp. So rather than the big strains and things like that, you're seeing a lot of repetitive motion back issues from the work from home environment. Yes.
Thank you.
Yep. Okay.
So that tells me you wouldn't expect a lot of long-term change between work, whether it's a return to office or a work from home environment. It should be fairly stable whichever way the workplace lands, I would presume.
Right. Yes. And certainly those that are, that require people to be in an office, a lab, a manufacturing plant, right? They're going to have higher work comp incidents. But you're going to see more of this repetitive motion type stuff on the work from home stuff, that where organizations are allowing people to stay at home. I mean, I'll just anecdotally, I'll share with you, our company provided each employee $500 to use towards improving their workstation. So they had, 2 months to decide how they were going to use it. It was a new chair. Was it a stand-up, sit-down desk situation? And you just submitted it through the expense account and it was paid for in an effort to reduce any work from home issues. Okay. All right. One of my favorite topics, and I've added a couple slides in here on SPACs that I thought you might find interesting. It was not part of the normal presentation, but I kind of nerd out on some of the IPO stuff. Management and executive liability. So this is D&O, employment practices, crime, and fiduciary, all things that involve the executives, okay? The biggest premium item in all of this is the D&O, certainly, and I'm going to spend some time on that. This has been really tough, okay? And this is all lines of coverage, and there's a delineation between public and private companies, and I'll talk about that in a minute, but boy, it's been really, really tough. And a lot of this has to do with the financial struggles of organizations, how they're handling COVID. Are they addressing COVID properly? How are they navigating supply chain issues, the retention, great resignation issues? Are they staffed appropriately? Companies are suffering, and when they start to struggle, it shows up on the balance sheet, and then they get hit with a premium increase. It's really tough. Bankruptcies are up. Certainly M&A has been very active, but this is really unprecedented as far as the size of the rate increase for the long of time that we've had it. So
are coverages getting restricted as well, or is it mostly just price increases?
There has been some limitations on coverages, and I would say normally it's them slapping on what I call a majority shareholder exclusion. So let's say you have somebody that owns 15% of the company, they'll say, okay, and they're excluded. And you're like, okay, that doesn't help me, so they'll do something like that. They are underwriting it much more aggressively. In almost every case, we're having meetings with the management team and the D&O underwriters so that the client can explain what's happening with their business. Yeah. It's important to tell the story, because a lot of times they won't understand it, you know. I have a hospitality client, 100 stores in the West, and they went through a really hard time. They were not doing delivery or takeout prior to the pandemic. And then they started doing delivery and takeout, and they made up, 30% of their revenue through that. But that brought on a whole new set of risks. They've got, all of the driving exposure and some other stuff. They started opening up their mix of revenue change, because they now have these 2 new revenue streams. The alcohol sales went through the roof, which is kind of funny, where they averaged 1 drink per customer, and they're averaging 2.5 now. So the underwriting, yeah, it's funny, byproduct of COVID. But so the underwriters are looking at all that and saying, you have to be able to tell that story to say, yeah, we might not be serving as many steaks, but we're making it work. We're at 80% of our pre-COVID revenue, which is pretty darn good. And they've made it up in other areas. So you've got to tell that story so that they understand. So this is for publicly traded companies. Just look at this. I mean, this is average. All right. The total program average a year ago or 2 years ago was 50%. That means some clients were getting 100% increase on publicly traded companies. And so just to give you an idea, I mean, a public company is paying $300,000 a year for D&O insurance. To take that to $600,000 overnight is incredible. I mean, that's what's happening in the life science and technology sector, what we do a lot here in San Diego. This was a real bear. Just tough, but you can see what's happened here. One of the dynamics is that one of the dynamics here is AIG pulled out of all life science in particular, and some public companies, and they were the biggest writer of primary D&O insurance. And that just sent everything into a tailspin. I mean, it is, the lack of competition. We had probably 4 insurance companies that were willing to write that first layer of insurance. Since then, a bunch of these underwriters have left their employer and started new syndicates. There were some new London facilities that have opened up. That competition is helping the market. And clearly you can see we're back to some normalcy, which is really good news, because this was crazy. I will also mention that, and I don't have a slide on this, and I'm happy to send you more detail, but the whole ESG deal, environmental, social, and governance program that is now coming to publicly traded companies. In particular, there's SEC reporting issues on what we're doing at the company level in those 3 areas. We have an actual exclusive program with 5 insurance companies. If you can show them that you have strong ESG programs, you will actually get a rate reduction, which is pretty cool. But they are scrutinizing ESG for the first time, and that's going to be a new trend. They're going to be asking about environmental, social, and governance programs that you've got going on in your organization. On private companies here, you can see tracking less than public companies, and a private company might pay $10,000 to $50,000, maybe $100,000 on the higher end. So you're looking at an 11-12% rate increase. So much more modest, but still it's all relative when you're getting hit on every line of coverage. In private companies, many times the driver of the premium is the employment practices liability, because it is combined with the D&O. As a public company, you buy 2 separate programs. On private companies, you buy the wrongful termination, harassment, and discrimination coverage with the D&O program. So you're sharing that limit. So they look very closely for private companies at the workforce and do you have any claims? What type of workforce do you have? So they do look at the employment side much more heavily on the private companies.
Brendel, if I can ask a question, backing up just a second to when you were talking about D&O with public companies, I guess my mind was moving a little slowly. But I'm curious, you mentioned that having ESG programs in place can have a significant impact on your getting better rates. Is that because most litigation brought by shareholders is precisely in those areas?
Yeah, that's the theory. That's the theory.
Okay.
And just to be clear, we have a program where we've negotiated predetermined rate reductions with 4 different insurers on the D&O program. But every underwriter is asking public companies about ESG. Yeah.
Okay, interesting.
One thing I want to mention, and Dan asked a question about Side A coverage. So when you layer a public company D&O program, think of it just like a casualty program where I talked about you have the primary layer of insurance, and then you layer excess on top of it to get to the amount of insurance. So if I'm a publicly traded company and I need $50 million of coverage, I might have 5 to 10 different insurers making up that $50 million tower of insurance, right? There is a coverage called Side A. Side A coverage is, think of it like a personal umbrella coverage for the directors and officers. So basically, it protects the directors and officers for acts that are non-indemnifiable, or if the company is not able to indemnify. So let's say the company goes bankrupt and they're not able to indemnify the directors and officers. The coverage A, DIC coverage, would be reserved just for the Ds and Os in that situation. It is protected. It's a very important coverage for D&O directors and officers. And so Dan's coverage question, I presume, was really about the pricing on that and availability. So the Side A difference in conditions coverage is definitely available. But what's happening, Dan, is the pricing, where it used to be a factor of the underlying, and it used to be discounted because it's only covering one particular thing. They're not discounting it. It's almost a dollar for dollar matching the excess layer underneath. So it's a pricing issue. It's not an availability of coverage. They're taking advantage of the fact that clients want this coverage, and they're pricing it almost the same as excess. You're not getting a discount like you used to. Many clients are, in order to preserve the cash on these programs, instead of buying the full 50 million of all D&O, the 3 parts of D&O, A, B, and C coverage, they might just buy 25 million of A, B, and C coverage, and then they'll buy 25 million of Side A, or difference in conditions policy. And that will be a little bit cheaper to do it that way. And so we're seeing companies restructure their programs to save money because the cost implications have been so significant. Does that help, Dan? I hope that helps with your question. Okay.
Brenda,
Yeah, hi, Tim.
hi, just one more question around ESG, sorry. You mentioned that companies will get a break if their ESG program appeals to their insurer. Are the insurers relying on the raters like Sustainalytics or MSCI, or do they have their own in-house evaluation programs that they've developed?
Yeah, that's a great question. They're pretty unsophisticated at this point. They're gonna go with what's on their application, and then they will submit questions to the broker about this. It hasn't been fully baked into their underwriting program, and I honestly, I don't know if they're doing homework behind the scenes, but they are reading the 10Ks, 10Qs. They're studying the company in detail, and they'll ask very specific questions about this.
Okay, thanks.
Yeah. Mm-hmm. This is early days, but I expect it'll become more sophisticated as we move forward. So I'm kind of a nerd about this whole IPO phenomenon that we went through. You know, these IPOs, they're going to pay probably a minimum of $300,000 to $400,000 in D&O insurance premium. All right. And the market went crazy. As you can see here, we had, almost 400 IPOs in 2021. That's unreal. And just a huge drop off to this year. So all of these, they were taking up tons of capacity in the D&O market, and pricing was just through the roof on these companies, and they've got now a 3-year kind of prospectus liability to deal with. They're going to be paying for a few years on those significant rates. What's even more interesting is the whole SPAC phenomenon. So you've got these SPACs that went public, 713 went public, and they have 2 years to identify a merger target and make that investment. And if they don't, they have to return the funds to the shareholders, right? So the question becomes, you know, the rest of these 592 are looking for merger targets, and time is running out. So I'm wondering, you know, is there litigation around misuse of funds? Are they going to make poor decisions in buying assets that might not be great targets just to check the box and get the money invested? I'm wondering if this is going to spur a whole new set of litigation and claims in the D&O area that would be very difficult for the market to hold on to. You know, these companies have to buy public company D&O insurance. Then when they de-SPAC, they have to put that program into runoff or a tail. And then the new company that's going to be the de-SPAC has to buy public company D&O. So literally the SPAC is buying public company D&O for 2 years. Then they have to buy a tail policy. And then the de-SPAC that they buy, they have to now buy insurance as a public company. So it's very complicated, and making sure all of these policies are coordinated. The last thing that I think is really interesting, look at this. There are 153 SPACs that have gone public since 2020 that between now and the end of the year have to do a deal. That's a lot. That's a lot of activity. So it's gonna, you know, you can see how many where the clock is ticking. So I just thought that was kind of a fun fact, and I thought I'd throw it in there.
Trindle, will the triggering event for this litigation be enforcement action by the SEC, or what will be setting it off?
I don't know. I kind of feel like these shareholders, I think a lot of these shareholders don't really understand what a SPAC is. And they're expecting that they're going to do this amazing merger and it's going to have all this glory. And then they do a deal that might not be well vetted, and there's problems, and the stock price goes down, and they're like, what? This is not what I thought. So I think it's going to be the shareholders not fully understanding, maybe suing the management team for, you know, misuse of corporate assets. I don't know. It could be regulation driven, but you know, maybe there'll be nothing. I don't know. But based on my years in doing this, I look at this and say, this is like a train wreck waiting to happen for the D&O market. Okay. Little fiduciary coverage. Okay, so those of you that are CFOs, you are probably the trustee on your 401k plan, you personally, okay? When you're the trustee of a pension plan or a retirement plan, you have personal liability for that plan. Meaning, if there's a lawsuit over proper plan administration, fees associated with the program, they can take your house and your car and everything you own if you don't have a fiduciary policy. This is a $2,000 policy, roughly. Not a big deal. So ERISA liability is specifically excluded under D&O. You have to buy a fiduciary policy. It's a tiny little policy, but it protects your personal assets as the trustee of the plan. Really, really important. Now, why is this important? We're seeing litigation for the first time. I've been doing this for a long time, never had fiduciary liability claim, and now they're coming in droves. We're seeing rate increases on these little policies. It's not about the rate increases, because that is not, it's a small policy. It just doesn't really move the dial. But the issue is excessive fee litigation. So you're using Principal Financial, and they're charging huge fees to administer the plan. And that's hurting your employee base on how they could be making money. You're not properly managing the plan, or you're out of compliance. We're seeing litigation against trustees for proper plan administration over fees, and it's a big deal right now. So this is an area from a litigation standpoint we should be watching. If you don't have the coverage or you don't know about it, you got to ask, who's the trustee of the plan, and do we have fiduciary liability coverage?
Just a personal anecdote on that, Trindle, Hal Dunning at your company, as you know, runs something called the CFO Roundtable.
Yeah.
And some of us on this call today are members of that. And I remember a few years ago, he had a speaker on details of the liability that a trustee took on. And I had formerly been a trustee of a 401k plan at my previous company before I moved to San Diego. And I remember commenting at the end of this that, boy, the one thing I learned from that talk, I never again want to be a trustee,
Right.
because you
Right.
take on an awful lot of
Yeah.
risk.
And you know what's interesting is larger companies with larger plan assets, they can say to a Fidelity, we want you to be the trustee. You can actually transfer that liability if you're a larger plan. It's the middle market plans,
Right.
where you get tagged as the trustee and you have that liability. So this is such a tiny little coverage that gets no publicity. It's really important right now. Yeah.
Well,
Okay. Now I'm going to talk about cybersecurity and data privacy. Oh my. This is probably the biggest area of challenge in the market. The umbrella excess is a challenge. This property valuation stuff that I talked about is a challenge, but what's happening in this area is just unreal. It used to be, half of our clients bought some kind of cyber policy, and most of it was just, a little endorsement to the general liability policy, and it covered the employee that sent something to the bad guy, and it was that kind of coverage. It was a phishing email kind of situation. It's not that anymore. It's happening all over the place, like massive amount of claims, and you're not hearing about it. You hear about the big ones, but the middle market client getting shut down, held for ransom, it is happening left, right, and center. And these systematic breaches where you're connected with other people, that's where you could take on huge liability, and the cyber insurance is really important. To this point, and through the pandemic, a lot of clients were just saying, hey, I've got insurance, I'm good. Like, they weren't really worried about it. But now the insurance company underwriters have become very sophisticated, and they're underwriting the heck out of this coverage. And they are, I put something in here, and this is my gift for you. I put in some detail on the 12 things that they're looking for when they underwrite. And I'm putting I'll show you the actual language and detail about it. But if you don't have multi-factor authentication, you're probably not going to get a cyber quote. You're going to have to qualify for insurance. So it's really important. I have a meeting tomorrow. I'm going to see a client of mine. He's a new CFO, and he's concerned about this company's ability to respond in a cyber breach. And he's like, I need you guys to walk me through what I need to do. What are the minimum things? So we're going to go over the 12 things with him in person. We have a cyber expert on staff, and he's a technology geek, and he's going to walk him through with his head of security. And they're going to walk through exactly what they're going to need to have before the renewal. And then we're going to if they don't get it all done in advance of the renewal, they're either going to pay a lot of money, or they might not even get coverage. So you can see here, the increases are 100% on average. Yeah, crazy. There's restrictions in coverage. It is really, really tough. I do want to mention, there was a couple, I don't have a slide in here on E&O and professional liability, and a couple of you are in businesses where that is a very important coverage. So with E&O or professional liability, the cyber is usually embedded in that. So you've got to be real respectful of the cyber exposure versus the professional liability exposure on the E&O, and make sure that you're treating those almost as two separate risk profiles to the underwriters. And it could be that it makes sense to actually split those out in this market. So as a broker, I would be looking at different options. You can look at it, combining it with the professional liability, or looking at it separately. I'm happy to provide more information on that to anybody that's interested in the E&O issue. So there's a lot of text in here. You know, I do want to mention that we work with our clients. We put together what we call the Cyber Resiliency Network. And basically what that is a group of lawyers and forensic accountants that are willing to provide 1 hour each of free consulting services to our clients to help them become more response ready. And so I know Brady Companies is a wonderful client of ours. If you wanted an hour of free consulting to have your security team meet with some folks free of charge, just to say, hey, here's what we're doing. How does that stack up against everybody else? Do you think we're going to be okay? That is available to clients in our world. Here's the graph, really ugly. It's just crazy. And the hardest part of this as a broker is again, the excess layer. So we're able to find that first 1 million, the first 3 million. It's if the client needs 10 million, getting to 10 million is tough, because nobody wants to be on the excess at that pricing. So you're not seeing a drop off in pricing. This is in our report. I'm going to send you the full report. These slides are only a subset of it, but in the report, we have these areas called minding the gap. And these are kind of to draw your attention to specific things on a particular coverage. We are very mindful right now of any exclusions that have war-related exclusions on the cyber program, because that would be a real disaster for our clients. So just want to call that out because of what's happening with the Russia-Ukraine situation and just the global environment in general with China and everything. You know, having a war exclusion on your cyber program is a non-starter, and they're just putting them on and hoping that brokers don't catch it. Okay. So this is the gift part I talked to you about. And this is kind of a takeaway document where you can look at, here's what the issue is with MFA. Here's the solution that they're looking for. And here's how we can help. But I think to take this internally and just talk through this with your team about, or with your clients, many of you are consulting numerous clients, to be able to ask them, how are they responding in these areas? Okay, so I've got this in the document, so you'll have that as a follow-up and a takeaway. So those are all the different pieces. And that's really the end of my chat here. I think I've got 10 minutes left. We can dive into more questions. I'm going to send you the full report that's going to have a little bit more content than what I've covered today. So you can dive into that, but I'll also send you my slides so you can refer to them and have them as a takeaway.
Trenda, one thing I'm kind of thinking of as I'm listening to you, there's a few areas that almost seem like they could be a subject for a whole hour presentation themselves. And D&O seems like one of those. Cyber insurance seems like one of those.
Yeah, you could go in. You could go into. I mean, we could go into a entire thing about that. And we have. I'm head of sales for the country, but I have people that are domain experts in property and in casualty and cyber and D&O, and happy to have them, you know, dive deeper if you wanted a public company D&O lesson or a private company D&O lesson, you know, that kind of thing, or cyber deep dive. We could have Tim do that for you.
Yeah, we might want. I know a few years ago, actually several years ago, we, for a couple of years, spread across a few years, we had a presenter on D&O. And of course that it was complicated then, but it's less complicated than it is now.
Mhm. Yeah.
Cyber certainly, to me, it just seems like the big issue driving cyber is that for the foreseeable future, the bad guys are going to be a step ahead of the good guys.
Yeah.
And as long as that's the case, insurance is just going to get more and more complicated.
Yeah, and it's crazy. We still have many clients that don't purchase cyber. And, we're providing a quote with every renewal to make sure we're talking about it and giving them the option. But, it can be such a simple thing. Just these malware attacks. I mean, somebody can click on something and then that's it. And they're in your system.
Yeah. Wow.
Any additional questions or things that,
Questions, guys?
I had a question on, have we seen, what are we seeing on claims on cyber, on denials? That's a great question. I think where there is coverage, so the way these policies are structured is you have a cyber policy has both property coverage, meaning it covers your loss in the event that your systems are down. Okay, so it covers your loss of profits. And it also covers your liability, meaning when you get sued because you impacted other people. So there's two parts to the cyber program. Not every client buys all parts. And some will opt for more restricted coverage because of the pricing. So it really depends on the scope of the pricing. I'll share with you, we handled the SolarWinds breach. That is a client of ours. And they were awesome. Afterwards, they asked to do a webinar with our clients so that they could share what they learned through the process. So we had them on a webinar last year about living through that whole breach. But there was coverage. It was awesome. Like we had a great recovery, and that was a very systemic kind of situation. Yeah, so it depends on the quality of the coverage and how the claim comes in. And there's varying sublimits. So, for a certain type of attack, you might have, 1 million, and another one, you might have 5 million, or you might have 100,000. So it really depends on what your program looks like. And that's where you have to be an informed buyer. You have to understand what you're buying. And you can't just take it off the shelf, because it'll likely have a war exclusion and some other exclusions, right? It's not going to cover all parts of it.
Trindle, are there any particular areas where clients should really be considering either moving to more self-insurance or moving towards a captive coverages that, based on what we've talked about today?
Yeah, I think companies that have large fleets, the auto market is horrific, and that transfers into the umbrella because the umbrella goes over the auto. So, if you have a large fleet, I would be looking at general liability and umbrella and auto in a captive would be absolutely make great sense. I think that's probably the most popular thing that we're seeing right now. It depends. You've got to have size and the balance sheet. But when it comes to self-insurance, I'll share with you that I'm on a board of a nonprofit, and they have some camps in a fire brush area, like in the middle of nowhere. They're camps for kids, right? And these are older structures. And from a wildfire loss standpoint, they're just getting killed. And this is a nonprofit, right? So the nonprofit has a slush fund, a reserve set aside for claims, for earthquake and for operating expenses. They have done a great job in saving for these kind of things. We're looking in that group they have a number of different structures, they have two structures. They have a sleeping hall and a dining hall that are critical to rebuild, to resume operations, but they have all these other outhouses, things that don't really matter, right? So we're looking at not insuring anything but those two structures. And they're going to self-insure the other parts of the operation out of their fund to just get the risk profile down so they can get the premium to be something reasonable. And they're taking higher deductibles and going to fund it out of the reserve. So yes, people are looking at self-insured retentions. They're increasing, the deductibles in D&O, in property, in cyber, just to get the pricing down.
Thanks.
Mm-hmm.
So Trindle, in regards to cyber insurance, should there be a disruption to the business and it's not automatically determined if it's cyber related or some other operational activity, where does the I guess the line fall in terms of is it business interruption or is it covered under cyber?
It's not covered under business interruption under property. It's excluded. If the event occurred from a cyber attack, it is now excluded under property.
Okay, and if you can't, it has to be understood to be a cyber event, like if it was some unknown process that infected your operations, but you're not sure if it was a
Yeah.
cyber event
Yeah.
or not.
So I want to mention this, and I didn't in my remarks, and this is a big deal. So the way these insurance policies work is the insurer will have a list of vendors that they like to work with in a claim situation. So they're going to have their lawyer, the forensic accountant, the remediation people. They have a panel of people. So if you have a network outage and you start to hire your law firm, your forensic people that you know, and they're not on the panel of the insurance company, they may not pay the claim. So the first thing you have to do is report the situation to the insurance company and have them drive the process. And they're going to help you with that. They're going to say, hey, it looks like this was a breach caused by, because it's what is the cause of loss, right? You have to determine what the cause is to determine exactly where it's going to fall under what policy. But the vendor selection piece is a very big deal. You have to use the vendors on their panel, or else they can deny coverage in total because they have pre-agreed rates with those people.
Is that actually written into their policies?
Yep.
Wow.
Yeah. And that's important because think about it. You're a CFO, you're buying the insurance, you know it. The crisis happens. Your CIO goes and hires their guy, right? They go and hires their firm that they like. And then, 24 hours later, they're all deep into it and you find out, no, we can't use that firm.
Yeah.
So it's important that the CTO, CIO, information security folks understand that relationship.
In our policy that we just renewed, it drops down to 50% coverage.
Yeah.
We
So
don't.
they actually specify it.
Yep.
Wow. Mhm. Yeah. And it's because they have pre-agreed rates and they don't want you to use someone that doesn't know what they're doing.
Right.
Right? Because they're jeopardizing their policy that they're paying the money on.
About a year or so ago, about kind of a new variation on ransomware. The historical ransomware was the bad guys hack in, they get your data and they encrypt it and they say, if you want to get back in business, pay us X amount of money. And companies could either pay up and get the codes to undo the hacking, or they could decide to try to figure it out on their own. But subsequent to that, the bad guys, for want of a better term, kind of came up with a couple of more interesting variations, which is you can choose to fix it on your own, but by the way, just be aware, we have your data
Yeah.
and we're going to sell it on the market to the highest bidder. And that was kind of a second generation thing. Well, that was pretty interesting. And then they came out with a third generation, which I thought was even more interesting, which is, by the way, we have your data. We're going to start contacting your customers. And we're going to ask them if they're willing to take the risk to have their personal data exposed, or if they want to pay up individually. How is that affecting?
Oh, it's huge. That's that's the worst nightmare of the insurance company. That's why the rates are up 100% because of that environment. And I'll say, when you have a ransom attack, you know, and they're asking for $1 million, these insurance company ransomware specialists know how to deal with this. They know how to manage it because they do it all day long. So that's where the policy can really help you, is just to navigate through that experience.
I'm curious, do you happen to know, and I don't know if you do or not, but you remember a year ago last month, the Scripps healthcare system in San Diego had a ransomware attack right at the beginning of May. And Scripps was essentially out of commission for the month of May.
Yes, I remember.
I think they came back like around the 27th or 8th or somewhere around there. I know this because I had heart surgery scheduled during that time and it had to wait. So I'm curious, and I was intensely curious at the time. You know, somebody would say to me, you know, I haven't seen anything in the news. They don't seem to be doing anything. And I said, no, I'm sure they're doing a lot.
Yeah, it was a really, really bad situation. I'm familiar with it. The Epic system that the hospitals use to communicate amongst each other. So, you know, if they want to share patient information between Sharp and Scripps and Kaiser or whoever, it was that system that was compromised. And that's the systemic nature, but it did boil down to what the controls are at the hospital. So it was able to be contained. So it was a really tough breach, very tough.